Hello again, everybody. Carlos Scarpero here, Ross Mortgage and Military Mortgage Boot Camp. Today I have something very important to tell you. As you can see, I'm on a separate microphone. My normal mic is a little busted right now. Well, USB issues with Best Buy, a whole different story. But this is so important, it cannot wait any longer. It's super important. Changes going on in the mortgage industry, and I want you to know about it ASAP. So, some guidelines are being changed, and there's some rate issues and a lot going on in the mortgage market right now. And I want to make sure you are well informed of what's going on. So before I go through this, I want to talk a little about how mortgages work, because without any sort of backstory about how they work, it's really hard to understand what's going on in the marketplace. So when you go to apply for a mortgage and it's funded and approved, there's no vault full of money that the money comes to you at. It actually goes through investors. So if you get a VA loan, it goes through Ginnie Mae, which is who does VA loans. If you get an FHA loan, it also goes through Ginnie Mae. If you get a Fannie Mae loan, it goes through Fannie Mae. USD loan, also, et cetera, et cetera. If you get a non-QM loan, they actually have private investors for that. Those are all sold on Wall Street, securitized. So if you have a 401k or a pension, guess what? They are investing in mortgage-backed securities. And so the lender will take the money, and then they pay those investors every single month. And there's a little bit of spread they get to cover the actual cost of the loan and make a profit on it. So those organizations, FHA, VA, et cetera, they have a base guideline. It can be a credit score guideline, it can be residual income guidelines, et cetera. And us loan officers know exactly what those guidelines are and put you in the appropriate type of loan for what you're doing. Now, lenders can put something on top of that, and those are called overlays. So, for example, if the lender decides, well, the FHA minimum guidelines are a little bit too loose, the lender can add additional things on there, and that's called an overlay. And this is very important to understand the difference between an overlay and a guideline. We'll get to this in a minute, because unfortunately there's a lot of people right now that are giving false information about this, and it's very important to understand the differences. So let's look at this effect of this coronavirus thing that's been going around, and I hope you're safe out there in Facebook land. So when it originated in China a couple months ago, there was some fear in the stock market, but not a lot of fear, not nearly as much as there is right now. But they were starting to pull money out of stocks and decided, well, bonds are still pretty safe, so let's move that stock money into bonds. And so that was what was happening, was the money was moving out of stocks into bonds. It was causing bond prices to rise, which is what was causing rates to drop. And if you've been following the market at all, you know that about 2 months ago, we actually hit an 8-year low. Loan officers like me went crazy, decided to call everybody in town, and there was a mini refi boom for about a month or so there. People went nuts, and a lot of lenders suddenly had full pipelines, and it was interesting. And so lenders hit what's called capacity. They only have a certain number of loans they can do in a day, in a week. These processors and underwriters still have to do all their work. The loan officer only take a certain number of applications per day. We've only got 24 hours in a day. Eventually, you run out of time to get them all done. And so that was what was happening. There was a run on the lenders all at once, which is pretty good for some paychecks, but sometimes there's too much of a good thing, which is what happened. So then this coronavirus hit us more directly, as opposed to just this thing that was offshore somewhere. Now we've got fears of recession. Businesses are closing. All of a sudden, one state after another is shutting things down. And we're all getting nervous, right? We're all very nervous right now of what's going to happen in the future. And the Federal Reserve, is going, oh my God, we're going to hit a recession. And the administration is thinking, oh my gosh, we're going to get blamed for this recession. We got to do everything possible to lower things. And so the Trump administration decided to lower what's called the Fed funds rate and throw everything in the market to keep interest rates down, 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 down. And so on a certain piece of the market, they can control what's called the Fed funds rate, which is the interbank rate. And if you've been following what I've been posting, I told you that the Fed funds rate and mortgage rates are not one and the same. The Federal Reserve can influence the mortgage market, but they can't control it completely. And there was a lot of misconceptions in the market when the Fed funds rate hit zero. People were like, oh my gosh, free mortgages. And that's not true at all. That all it does is influence the mortgage market. So what did they do? They started buying mortgage-backed securities in an effort to raise the bond prices and lower interest rates to try to keep the economy flowing. Just one problem, that the investors, the mortgage holders, or the pension funds that are buying these mortgage-backed securities are suddenly running scared because they see that, one, inflation's probably going to come back because of all the spending by the federal government. Two, we're going to see some massive unemployment soon. And we've already seen, 3 million jobless claims last week. I'm seeing reports of what could potentially be 20 to 30% unemployment. And there's a lot of fear right now, as you might imagine. So the one side, so the federal government is trying to lower rates, the investors are trying to raise rates, and so now all of a sudden it's got this volatility, and we've been seeing these wild swings in the marketplace. Not good, because for a mortgage company, they need the rates to stay somewhat stable between the time you apply and the time it closes. And there's a lot of volatility. They actually have something called a margin call, which very short explanation. They're using stock options or bond options, I should say, to hedge their bets on interest rates. And it works well when the market's stable. They can use that and keep things pretty stable on what rate you lock in versus what rate they actually get when the loan closes. But right now, because of all the instability, they're starting to hit what's called a margin call, which means these bond options traders are wanting millions and millions of dollars from mortgage companies, and that's not good. And our Quicken was hit with several million in margin calls last week. It's getting kind of crazy. Also, mortgage holders, we've got a whole new problem, is the federal government, in all their wisdom, decided, well, we're going to do forbearance now. And if you don't know what forbearance means, that means it's that someone who has a home could possibly skip mortgage payments. And I think it's a bad idea because the way forbearance works, they don't tack it onto the end of the loan. What happens is you get a deferment. If you ever bought something at Best Buy and got the 90-day same as cash type thing, it's basically the same concept where they let you go 90 days to up to a year with no mortgage payments. But what happens at the end of that year, they say, hey, you got a year's worth of mortgage payments due. Well, gee, now you got to pay $12,000 to this mortgage company to get caught up, or else possibly go into foreclosure. Well, who has that? So we got this forbearance thing. The government didn't fund it. It's more of an unfunded mandate, which is horrible. And mortgage companies are fearing unemployment. They're thinking, oh my gosh, we're going to have 20% unemployment. We're going to have forbearance. We're going to have foreclosures. Bad, bad, bad. Well, let's raise rates. Let's start pulling back on the marketplace. That's what's happening right now in the market. So they decided to add what's called lender overlays. And so Fannie Mae and FHA, they're kind of, I don't want to say asleep at the wheel, but they're not really taking the lead on this. It's the mortgage companies. They're saying, you know what? If Fannie Mae and Freddie Mac and FHA are not going to take the lead on increasing standards, we're going to do it ourselves because we're getting kind of scared that some of these people are going to default and some people don't have enough savings to weather the storm if they get unemployed. And so we're seeing a lot of lender overlays right now. Pretty much every lender in the business is adding overlays. Whoever's not is just a liar, or their company is about to add them and they don't know it, or they decide, well, we're going to do the 580 FHA loan, but we're going to make the rate so outrageous that it'll cover our bases, which I don't know about that, but that's kind of outrageous too. So right now where I'm at, Ross Mortgage, we're at 660 minimum score. I'm here for people from other companies that are in similar markets that are 660 seems to be pretty much the average right now. Some companies are going lower, but will jack up the pricing to just some outrageously ridiculous levels. So let's think about this though. For every problem, there's an opportunity. And so for borrowers that have good credit over 660 and have good stable jobs, this is getting really interesting because now, instead of having 10, 12, 15 bids on a house, you might be the only one looking at it because all of a sudden there's a lot of people that can't get that house. And so for people that are interested in buying a house that were maybe locked out of the market or stuck in this really competitive situation, you're going to see some opportunity, because all of a sudden now you go and look at that house and there's not as much interest because there's not even qualified borrowers, and you could potentially get into that house you couldn't get into before. So at least there's a silver lining there. We're also going to be seeing some people moving, because with unemployment causes people get new jobs in other areas, which is going to cause more people to put their house on the market. So there's going to be more opportunity there for people to find houses they couldn't otherwise find. So that's what's going on with the mortgage market. As always, if you have any questions or comments, feel free to reach out to me. My number is 937-572-3713, or Scarpero.com. I am licensed in Ohio, Kentucky, and Michigan. I hope to talk to you soon. Later.